Hello and welcome everyone to another episode of All Things Real Estate. As always, I am your host, Kyle Seyboth with Century 21 Real Estate, serving Rhode Island, Massachusetts, and Connecticut. Guys, this week we have brought back a lender. We haven't had a lender on here in a while, and I think it's really important with the current market environment. So today, unlike any other session, we have a special guest. And sir, what is your name?
My name is TJ Curran, and I'm a loan officer and branch manager with Fairway Independent Mortgage.
TJ, let's start like so basic.
Sure.
What is the difference between a loan officer, a mortgage broker, a loan originator,
Sure.
and someone that works for like Pawtucket Credit Union?
So a lot of those terms are synonymous. A loan officer and a loan originator are the same thing. A mortgage broker is someone who they can go and try to sell your mortgage to different companies, and they're typically kind of a independent contractor. And sometimes that situation is good, sometimes it's bad. And someone who works for a bank, they're a loan officer, they're typically licensed under the bank's charter license. And again, it can be good, it can be bad. It's basically every loan and every loan situation is so specific that you got to find what's right for you.
So if I work at a community bank, let's say a local community bank, can I bring in client A and have them financed through Wells Fargo or?
No.
Right.
So if you work for a bank, the bank is the one that does the lending.
Right.
Right. So unless you work for Wells Fargo, then you
Correct.
can work for Wells Fargo. Yeah.
So if I'm at, I'll just use Pawtucket Credit Union for example. Pawtucket Credit Union cannot go ahead and broker the deal with a Wells or a Mr. Cooper.
Not typically, though. There are banks that will broker jumbo products or non-QM products. And so it depends on the bank too. Smaller banks like Pawtucket Credit Union, they typically lend their own money, and they're not going outside the norms typically.
So if I'm a buyer, right, and I'm looking to get the best possible deal on the market, and I'm a buyer, let me give you some criteria, right? I make $80K, my credit's 700, I've had a job for 2 years, I have about 50 grand in the bank, and I'm looking at a $300,000 house. What would be the best advice or best product you could put me in that would help me in the future or help me in the present? Like what product, what would you say to me? What would you suggest?
I mean, it depends on what you plan to do in the future, but with that much money in the bank and your credit score and your job seems to be pretty stable, a 30-year fixed rate with 10% down, and the reason I say that is once you get to a certain amount of money down, your rates improve, the level of private mortgage insurance goes down, and also you still have some money in the bank left over, so if you need to do repairs or you need to buy furniture, all the practical stuff that goes with it, you're not completely depleting your savings. Your 30-year fixed, because that's a kind of a one-size-fits-all mortgage plan. It's going to give you the lowest payment, for the choices that we have: 30-year, 20-year, 15-year, and it's typically a flexible program because first-time homebuyers, by and large, only stay in that house between 5 and 7 years. So they're not in it for 30 years. So ideally, you want your payment to be as low as possible so you can make that adjustment from renter to buyer or owner.
So 30-year fixed means that my interest rate today will be the same it'll be in 2040.
Correct.
And if I put 10% down on $300,000, that means I'll put $30,000 down.
Correct.
And let me twist it a minute. And this is going to be a real world question that's happening now. If I'm a buyer and I'm astute and I get it, and I understand that this market is not going to be hot forever, but I know I'm overpaying, and I may want to sell in 5 years, would you recommend that I put more money down or less money down? And there's no right or wrong answer. I want to hear your answer, and I'll give you mine.
Yeah, so I think you put less money down. So typically, a down payment and using a 30-year fix because you're going to be in a certain amount of time, it's typically because in this market, your appreciation outstrips the amount of principal you'd pay in the number of years you're in the house, right? if you think that the appreciation is not going to continue at the current rate, then you want as the least amount of money in that house in equity as possible out of your own money. And that's my belief.
Same answer I had. Because I think that you want to make sure, let's just say for whatever reason, you just sell in 5 years, or
Right.
you could always rent it. You could always keep the property and rent it, and you still have capital. Versus if you put so much down and now you want to rent, you're not going to be able to refinance because you can't cash out because the loan to value is not there.
Right.
Right? If you go to sell it, you may not get any of that capital back, so that capital may be whittled away.
Right.
And if you decide, the good thing is if you decide you do rent it, you still have a lot of capital in your pocket, so you can go purchase something else conventionally.
In investing, you call it sunken costs, right?
Yeah.
And you want your sunken costs to be as little as possible.
As low as possible.
Yeah.
Now, you don't have a crystal ball. I do, but you don't, unfortunately.
Right. Can I borrow it?
You can have it. How long can we keep this up? How long, first of all, can rates stay low?
Well, rates can stay low as long as
The Fed allows it.
as long as the Fed keeps buying mortgage-backed securities at the rate they're buying. So they're already starting to talk about easing that buying of mortgage-backed securities by the Fed. If I could borrow your crystal ball and look into it, I think we're going to start seeing rates creep up by the end of the year. But it also hinges on the fact that right now the real estate market for a long time has been propping up a lot of different other parts of the economy. But with materials to build the cost being so high, and the market is the most one-sided I've ever seen it in my career. The sellers have all the power. I'll give you an example. House that a friend of mine just sold. It was listed for $650. It sold for $800. Cash offer, no inspections, no appraisal.
Wow.
Yeah.
150 grand over.
150
with
grand
no
over.
appraisal.
No appraisal.
And no inspections.
Right. So you can't compete with that. If most people can't compete with that.
You can't, and that's the problem is
Right.
when you go to these properties, all it takes is one of
Right.
those people, and you're done. You
Right.
got no chance.
Right.
So there's so many disgruntled buyers that have no chance of getting these houses because one Sharon or one Kath, what do they call it? Karen. One Karen came into play, and Karen decided she wanted to be cash and go get. You know what I'm saying?
Right.
And I think that's the part. So that guy or girl who did that, or family or whatever, they're paying 150 grand over asking.
Right.
What, you have to die there.
So, well, it's a person who has the means to do that, and I kind of in my mind was thinking, why would someone do this? I think it was a vacation area in Rhode Island. I think they thought they'd be in at $1 million, right? So it's a beachy area. They thought they'd be in $1 million. They found a house that was less than $1 million, but turnkey, and they said, all right, I'm still 200,000 off what I thought I was going to.
Yeah, I'm still winning, right? So yeah, all right, I was gonna. That makes sense. So those are tough deals, but I see that a lot, and I'm like, what are you doing with this? Like, what's the game plan?
Right. Yeah.
I get that part. If it's a vacation home and you were going to spend X, you're going to keep it and pass it on to your kids and their kids and so on and so forth.
Right.
Fine, whatever. No big deal. But at the end of the day, the normal buyer buying a residential property to live in, I'm seeing stuff go 110 over.
Yeah.
100 over.
Right.
50 over, 75. The multifamilies make me the most nervous.
Yeah, well, because the multifamilies are dependent, especially if people live in them, they're dependent on other tenants to kind of make the person owning it whole, and
I'll give you an example of one I had. We listed this property a year ago, maybe a year and a half ago, for $300K. Now the first floor tenant destroyed it. It was a complete mess, total mess. I owned it. It was a complete mess. The tenant was still there. I couldn't get anyone to offer on it. This is about a year and a half, 2 years ago. Finally was able to evict the tenant, renovate the first floor. Now just hardwood floors, Grossman's kitchen, nothing extravagant, Formica countertops, right? Spent about $25K in the renovation. Did the hallways, hardwired the smokes. What do you think it just sold for?
You were into it for you couldn't sell it 300?
Put 25 into it.
410.
470.
470?
470.
Wow. That's great. It's crazy.
470.
How many units?
3.
Wow.
In Pawtucket, a 4-bed, a 3-bed, a 3-bed. No, 4-bed, 3-bed, 2-bed.
Wow.
470.
Well, the rent. So it's also a chain reaction because in order for the person to buy the house, for it to make sense for them, they have to raise the rents. And depending on what part of the state or whatever, certain people don't want to pay, $2,500 a month for a 2-bedroom apartment.
And then my concern is that, now obviously I was on the sell side, so the buyer had their own agent. That wasn't even the only offer. We had another offer at $460 and another at $450.
Wow.
So my concern now, as looking at the market from a holistic standpoint, what happens when no one pays
Right.
their mortgage on 470? What's the FHA mortgage on 470?
Well,
Ballpark it.
Well,
Assume taxes like $300 a month.
30,
Yeah.
32, 33, 34, 30.
So
3,500?
32 to 3,500, right?
Yeah. Because there's mandatory PMI for FHA loans.
So
and
think
it's
about
0.85 of whatever loan amount.
the loan amount.
Yeah.
So think about that. The purchase price, right? $3,300 is their monthly payment. They have to get from the 2 floors $3,300 to make it make sense, right, for them to live for free.
Right.
Or right.
Right.
But let's say they're getting $1,500 from the first floor, $800 from the second floor. That's $2,300.
Yeah.
So for them, they're paying, I guess you look at it like that, they're paying $1,200, not a big deal. But if the other 2 floors don't pay, there's no way they're going to be able to cover $3,400.
The other thing is, this is aged inventory, right? A lot of these houses were built in the 40s.
Right.
So say they need a new roof or
Deferred
a new boiler
maintenance.
or something happens where they need extensive repairs. Typically, these buyers are not cash flush. They don't have a lot
That's the second part of it, is the deferred maintenance.
Right.
Roof goes. Here's the other thing. With the 3-unit, you have 3 boilers. You have 3 hot water tanks. You have 3 kitchens.
Right.
You have 3 bathrooms. You have 50 windows. You have a roof that's going to be 2 times what it would cost on a rent. So you have a whole bunch of deferred maintenance that could come up.
Yeah.
And if you're an FHA buyer and you put down 3.5% on $400K, that's $15,000, or give or take, whatever that number is, right?
Yeah.
You put that down, and all you had was $17,000. What do you do?
Yeah.
The boiler goes and I have $1,000 left. What do you do?
Yeah.
Like, what's the answer? You have to either not pay your mortgage to pay the boiler, or you don't have heat.
Right. Yeah. Yeah, it's a tough situation.
And that's why we got in that same spot we were in before, is because a lot of people couldn't, they had to make a decision. Either I don't pay the mortgage and I hope that they keep pushing off a foreclosure, or I pay for the boiler or the windows or the roof or the siding or whatever and go from there. And a lot of people picked the latter.
Yeah.
They decided that they had to live, so then, the mortgage doesn't get paid.
Right. Right. Yeah, I mean, back in 2008, it was typically people's second homes or investment properties that were foreclosed on.
Right.
Yeah.
And then it trickled down.
Right. Right.
So I've heard there's a lot of foreclosures in the pipeline
Yeah.
from a bunch of people. Obviously, with the moratoriums, they've pushed things off, 16, 18, 24 months, whatever that looks like. When do you think they lift these moratoriums?
I think sooner than later. I think
you?
Right now it's set for September. I don't think it's going to be beyond that, and I think they might move it up.
Really?
Well,
I think they're going to push it till the end of the year.
You think?
I think they're going to push it. I think this year's a moot point.
Okay.
The year's wiped out.
Yeah, I mean, I guess for the servicers that the loans are on their books, they can write it off, and it might be better than chasing foreclosures, because foreclosure is much more expensive than a forbearance.
Right.
For the lender, for the servicer.
Right.
So,
any last advice as we wind down to a buyer right now? What would you say if you're meeting your son's looking to buy a house? What do you say to him?
I say, you're 3 years old, slow your roll. But
hey,
no,
son.
I would say, make sure that you work with people, both a lender, agent, who have relationships with other lenders and agents, that kind of know the situation, go in with eyes wide open, and make sure that your pre-approval, if you can, it can be, is fully underwritten. Meaning you can submit your offer with a commitment letter, because that's the only way you're going to be able to compete with the Karen submitting cash offers.
Right.
If you have I'm starting to fully underwrite all my pre-approvals, because that's the only way you're going to compete. Mm-hmm. If you have 20 offers, the only way, I have relationships. I'm lucky to have a relationship with a lot of different agents, but I don't know everyone.
Right.
So the paper has to stand up.
Here's the other side of that real quick. So if I get 20 offers on a property, we're not going to be able to go through all 20.
No.
There's no possible way.
Right.
So you know what we're doing? oh, that person's difficult. That lender I don't know. This one's difficult. Like if they're
Right.
close, those are just getting pushed to the side.
Right.
We're not even going. If I know it's a difficult agent, bye.
Yeah.
Get it over there.
Yeah.
But if I know it's a closer, all right, we got opportunity here.
Yeah.
So I think that's an important part that, like you said, your relationships matter more in this market than they ever will.
I agree.
And that's a key piece. Today was good. Today was rock solid. We gave a lot of good advice. Guys, hopefully you guys watched and listened. We are at the end of today's broadcast, and we appreciate you guys so much. Thank you for coming on.
Thank you for having me.
We will talk soon. Thank you all.
Thank you.